And we are live. Good morning, good day, good afternoon, depending on where you are in the world, where you're watching this and when you're watching it. My name is Clara Lyons-DeVaughn. I am the broker owner of Lyonsview Realty. We are a full service real estate agency providing residential, commercial for small businesses and nonprofits, and property management services. And I'm excited to announce coming soon Lyonsview Academy, our educational arm. Really excited about that. So, Lyonsview Financial Fridays is here to provide you with information to assist you in making the best financial decisions. Our commitment is to maximize your wealth building power now and in the future. Financial Fridays is here to help you stay current on trends that impact your bottom line. So glad you tuned in today. Welcome, welcome, welcome. Feel free to like and share this video. And if you have any questions, you can type them in the comment section and we will respond back to you. So our guests are here as a resource to you. So feel free to ask any questions and get the information that you need. I'm really, really excited. Today we have Mr. Antrone Daily from Annie Mac Mortgage. Welcome, Antrone.
Hi there. Thank you. Thank you. Thank you. Giving me a chance to get up and actually put on a tie and stuff with all of this working from home. It's like, thank you.
You're welcome. I had this little running joke, my pajamas get mad when I get dressed because we're developing quite a relationship.
I would have to agree with that one. I would have to.
Indeed. So tell our audience a little bit about yourself, Antrone.
I'm Antrone Daily. I'm a loan officer with Annie Mac Home Mortgage. I've been with Annie Mac, I'm going to say probably about 5 years. I've been in the mortgage industry over 25 years. So, and I like to think if you have an issue and I haven't seen it, I don't know how I missed it. Okay, so it's one of those things. I've been around for a while. I do a lot of the renovation loans, and I've recently started getting involved heavily with the reverse side of the table. So I'm glad to be here. Thank you.
Awesome. Well, thank you for joining us today. So you said the reverse side. So the official title is a home equity conversion mortgage.
Or
And
HECM, yes.
HECM. So we were like, what the HECM? No, they are not swearing at you. They're talking about it's actually not a new loan project. It's been around since 1988, I believe, which is quite a while. And it's a great financial tool for certain individuals. So we're going to get into that a little bit more. So why don't you tell us what the HECM mortgage is? Like just a brief overview.
Quick overview is this. If you're over 62 years of age, if you live in your property, and if you have equity, you're eligible for the program. Okay. One of the benefits of the program is that it's a reverse. Mm-hmm. And when I say that to people, I have to explain to them it's this. It's a mortgage. That's all it is.
It is a loan.
So
yes.
If you have a mortgage on your property, and it's what we would say a forward mortgage, that means that you're going to make mortgage payments every month on your principal and interest. Mm-hmm. When we say reverse, just think of that. Instead of paying, you don't pay. So instead, you take your money out of your house, you're able to hold it, look at it, do whatever you choose to do with it, but you don't have to pay it back. You don't have to pay the principal and interest back. The beauty of the program is that all you have to pay is what you would normally pay, meaning you would pay your insurance and you would pay your taxes on your property. That's it.
Right. Yeah. And I think the key thing, because my seniors, those who are 62 up, they say retirees, but everybody 62 is not retired. So, but right. If you're 62 years of age, you don't have a mortgage payment anymore. So the only thing, you have to either transition, or move. And during that time, It's still a loan, it's still out there. You just don't have those monthly mortgage payments. And I think that's really powerful tool. What are the main requirements to get this type of mortgage? So one is you have to be 62. What's the other one?
What do you mean? The 62?
Yeah, you have to be 62 years of age,
Yeah.
and you have to
This is
doesn't have to be your
yeah.
primary residence, I think is the other one.
It has to be your primary residence.
Yes, yes,
So the 60. So you have to be 62 years old.
yes,
You have to have equity in the house,
yes,
and it has to be your primary residence.
yes.
And what happens is this: a lot of times, seniors might have lived in their houses for 30 years. They might have a very small mortgage on it, or they could have bought recently. I mean, I've been dealing. Let's put it this way: somebody's 50 years. Somebody bought the house when they were 50.
Mm-hmm,
Right now, they've been in the house for 15 years. They're
mm-hmm,
65 years old.
mm-hmm.
They were one of those people who actually bought at the right time when they bought. So they bought very low. The market has changed in their neighborhood. It has increased. Right now, she has maybe, I think her house she has 70% equity in that house right now.
Mm-hmm.
But she's been making a mortgage payment, I think, of $2,300 or whatever.
Wow,
Out of that $2,300, $1,000 is principal and interest on her mortgage.
mm-hmm.
So technically, by doing this mortgage with her, we just basically gave her a extra $1,000 in her pocket every month
Wow.
that she can choose to do whatever it is she wants to do with it.
Right.
Now she's still working, and she's 65 years old, but she was one of those people who was in the perfect scenario for her. So she will not have to make another mortgage payment as long as she lives, and she owns her house still free and clear. It's still her house, and she doesn't have to worry about moving or doing any of those things.
That's pretty awesome. Pretty awesome. So she's
Yeah.
saving that payment every month essentially. Yeah, that's
Hmm.
great. So how much can a borrower get, under this loan?
It's based on age.
Okay.
So when you're looking at this, if you're 62 years old,
Mhm.
it's gonna be the tightest part for the equity position. That way, at 62, they're gonna look at and say, and I'll put it this way, just so we're all clear, it's based on how long they expect you to live.
Okay.
So if you're at 62 right now, they expect you to live at least another 20 years.
Yeah.
So the equity position in that house is going to be different. If you're 85 years old, well, you know what? At that point, they will give you more equity in the house. So hold on, let me see if I can look it up real quick for you. So at 62 years old, if you had a mortgage of $150,000, let's say,
Okay.
they would give you could have $90,000 of that. So that you gives you about $55,000 that you could take out of that house if that was the situation. But at
Okay.
80, the same house you now can take up to 77,000, which basically gives you another $20,000. Did that make sense?
Okay. Yes. So
Did
what
that
you're
make
saying
sense?
is, yes, depending on how old you are. So 62 is the minimum requirement. You have to be, at least one of the borrowers has to be 62 years old. And you can have multiple borrowers, but one of them has to be 62 years old, right? And then depending
Right.
on how old they are, the value of the property, so how much equity they have in the property, and that will determine how much money they can pull out,
Correct.
and that it there's a sliding scale based on how old you are, basically.
And what I should have said, maybe this would make it a little bit easier.
Mhm.
If you have a house that's worth $150,000 and you
Mhm.
have no mortgage on it,
Yes.
you would be able to pull $96,000 from that and
Okay.
not have to pay it back. The same
Okay.
scenario at 80 years old, you'd be able to pull out. Your house would be. They would have $77,000. It would be your equity. So you're basically right in half. So 50% of the house, you could take the equity out
Okay.
and
So
not have to pay.
it's not 100% of the equity, but there's a percentage formula based on how old you are and what you
Correct.
own the property, basically. Okay.
And I
And,
have all of this available to you too. So I can get it out to you if you need it.
well, I have a birthday coming up, so I'm getting closer to that. I'm getting closer to that time frame, so I want to know what my options are. So when, like, how does repayment work? When is the loan due?
When the last person leaves the house. So let's say you're married
Okay.
and both people are there and one
Okay.
person passes on. Well,
Okay.
the other partner still has the rights to that house and
Okay.
they don't have to move. That loan does not get repaid until the last person on the mortgage moves out. One way, if they move, sell, or if they pass on.
Okay.
Now, when that happens, it's just like any other mortgage. I mean, if you had a forward mortgage and you had two kids
Mm-hmm.
and you passed on, someone would have to pay that mortgage.
Yeah.
So your kids would then have to get a mortgage to make sure that they bought the house or they sold the house or whatever. The same thing happens exactly the same way with a reverse mortgage,
Mm-hmm.
except the reverse mortgage has a couple of features built in
Mm-hmm.
for your people that you leave.
Okay.
What they're able to do is they basically have about 6 months in order to get themselves together to actually purchase the house or to sell the house. So all the options are still there. It's still in your family.
Mm-hmm.
It still has equity in it. It still has a great position, a good position for you. Sometimes it's a little bit easier to do it that way because now at least it gives you. Sometimes people just don't have a chance to get ready, and with this you're able to transition the right way and your family isn't under stress to do anything. It gives them enough time to get ready for you.
That's interesting because that's one of the biggest myths about the reverse. People think, oh, once um, you said there were two ways: you either pass or you sell the property. But the children think, oh, if my parents get a reverse, I won't be able to get the property on their transition, and that's not correct. They actually can purchase the property just like they could if um, on any other mortgage. They can purchase the property, and they get to purchase it at the position, of what's
Of
owed on the
whatever.
property. It's not the
Correct.
current market value; it's whatever is owed on the property at that time. So it's actually a lot cheaper for them to get into the property at that point in time, and the parent or the senior has all the benefits during all that time. They don't have a mortgage. They only have to pay their taxes and insurance. So, or, well, we'll get into the different things that they can do with the money in a minute, but
But it
that,
sounds like you're really getting ready for this. It's like you're you said, I have these answers. Let's figure this out.
I have clients who, they say, oh, well, my kids don't want me to do this because, they want the house, or they want their legacy or whatever. And I keep telling them they can still have the house just like they would on any other loan. It's not stopping that.
And it's
So it
funny.
doesn't automatically go back to the bank is the thought.
Right. And you bring up that part for the kids.
Yeah.
And a lot of times what we don't understand is that you're actually helping your parents by removing that debt from them.
The financial
And
burden. Yeah.
I think I told you, well, I did tell you before. I had a client where we actually did the reverse mortgage for them,
Yeah.
and the kids got upset, and they didn't understand why it was a benefit for the parent to actually have that reverse mortgage. And the woman called me back. I went back in, I refied her back into a forward mortgage, and she got sick maybe 6 months later. And
Wow.
because she was sick with the forward mortgage,
Oh,
she
your screen just froze up. Say that again. Uh-oh. Okay, so Antrone's screen is freezing up. But one of the things that so I can't hear him, but one of the things that he told me the story, the client had um, went into the HECM product, the reverse mortgage, and the children didn't want them to be in it. So he put them back into a regular mortgage, a regular loan. So they had a mortgage payment, and then the mom got sick. So now she's not able to make the payments. Neither is the children able to make the payments. So they just I don't know if you can still hear me. If you can still hear me, just type in the comment section. I can still hear you. So the children weren't able to make the mortgage, and now the mom is in a position where she can't, where she can't do anything with the property. So had they stayed in the reverse position, once the mom got sick, she still wouldn't have had any mortgage payments. The children would have only had to pay the taxes and insurance on the property. So they ended up losing that property just because the children didn't understand that it was a better financial position for the mom, for her to be in the reverse. So a lot of times just having information is really, really important to know what's going on. And hopefully Antrone can join us back. But the other thing that people ask is, how can the funds be used? It's a financial tool. So when you pull that money out, there's several ways that you can pull the money out. One, you can pull it out one time, just like at a lump sum. Let's say you have $20,000 of equity available to you. You can pull that $20,000 out. You can do, dental appointments. You can do, if you have an expense, you want to do some repairs on the house, if you want to help your grandchildren go to school, if you want to, anything. You want to take a trip, you can use the money for whatever you want. It's a lump sum of money. You can use it however you want to use it. The other way you can do is you can get what's like a line of credit. So basically, for a specific amount of time, you have, say, $20,000 in funds available to you. You can take $2,000, you can take $5,000, you can take $1,000, you can take $500. It's a line of credit for you to use however you want, but there are no payments on that money. The other way is you can take set payments over the life or the term of the loan. So let's say, again, same $20,000, you get $200, $300 a month that comes into you, and you can take that money, you can invest it, you can pay your other living expenses, you can do whatever you want, but it's consistent over the life of the loan. And then the last way, or not the last way, is if you can do a combination. So you might do a lump sum one time, you might have a line of credit, another time you might have, I think Antrone's coming back. Okay, there you are. I was just explaining the different ways that you can use the funds. So the one-time payment, the line of credit, where they can do equal payments over time, or they can do,
Well, what you're looking at. Yeah, so what you're looking at is for the lump sum means that basically you're going to go in and you're going to take whatever amount you want right away. They'll just give it to you. Now, what happens is this: they're only going to give you 40% of it when you close, and then they'll give you the rest of it the following year. So if you have $100,000 available to you, what they'll do is they're going to give you $40,000 on the day of closing, and then 1 year later they'll give you the rest of the funds. And the reason they do that is because I don't know how many times we've run into where we might fall into a windfall of cash and we just spend it.
Right.
For that, you want to make sure that the people actually understand the funds that they have and how important it is and how to use it. So they try and monitor it a little bit so that it helps you out a bit. With the line of credit, that's for your lump sum. With the line of credit, they will tell you, they'll give you whatever your equity position is, and it's just like a regular line of credit. That means that you can go in and write checks. You can ask for funds whenever you want it, and they'll be able to give it back to you. The only difference is that with the bank, when you have a line of credit, they say, if you take X amount of dollars out, we want you to pay X amount of dollars back. With the reverse, with the HECM, you don't have to do that. Those things aren't required. The next one is going to be, you can ask for a set amount of money every month. So some people use it just like they use their pension. That means that, every month I want you to give me $1,000 out of the funds that I have available to you. And they will do that until you reach your max. So again, you can set it up so that you can get 500, and you can stop it anytime you want also. Mm-hmm. And again, with the HECM mortgage, my client is the person in charge. So it's however you choose to make these things work for you. Mm-hmm. The other part is and just for the line of credit and the lump sum, I want to go back to that for 1 second. And right now, in the market that we're in, many of the financial advisors are now giving me calls asking, how does this work and what can we do to get their clients into it? And on the other side of the table, I am not a financial advisor. I don't know I'm not that smart. On the mortgage side of the table, I think I'm pretty intelligent and I can figure out how to make sure things work for you. But I'm at this point, it's where the financial people are saying that this house is an asset, and we have to understand it as such also. It's an asset. That means that our assets, we want them to work for us. And a lot of times we will have equity in a property and we'll go home every day and go, wow, my house is worth $150,000 and I owe nothing on it. Well, that $150,000 that you now have in your property is not working for you.
Yeah.
And what you can do at this point is talk to whoever your financial advisor is. Ask them, how should they make this work for you so that you'll have these funds available to you in your later years? Because what a lot of times what we do is we have things and we don't enjoy them. Yeah. And a lot of times we have to understand that it's okay for us to enjoy the things that we've worked hard for.
Yeah.
And if we plan right with the right people, we will still have a legacy to leave to the children. Yeah. But we need to enjoy life sometimes too. And as seniors, sometimes that, it just doesn't resonate that these things are still good for you.
Indeed.
So I would say, yeah, with the assets that you have, you can do it. You'd be able to do that. As a matter of fact, one of the applicants called up with their financial advisor and their realtor. Mm-hmm. Who knew, right? But they called up and they had found one of those little projects that this will be able to buy this house, and we will be able to renovate and put it back out, all without, all through their funds. And what they were able to do is they were actually able to buy, they were actually able to rehab, they were actually able to sell, able to take the money that they took out and now give it back to their financial person, because now he has double the money that he started with because of the reverse mortgage and the equity position that they had in it. So am I saying that you should run out and take your money? No, I'm not saying that. What I'm saying is that we need to make sure that we have the correct people in the corner, in our financial corner, so that we can get to the spot that we're trying to get to. And it's always a good time to invest as long as you know how. So I always go back, I go back and say, you put the right people in your corner so that they can move you forward to the next step.
Indeed. Now, one of the things that I am really excited about, and I don't think a lot of people know about, is HECM for purchase or reverse mortgage for purchase. And probably, I think about 2 or 3 years ago, there was a speaker who came to our event, our Community Wealth Building Day for the Southern New Jersey chapter of the National Association of Real Estate Brokers, which is how I met Antrone, who is one of our affiliate lenders in the organization. And I was sitting in on this workshop and I was like, oh my God, I can actually, I'm getting there. I'm not there yet, but a person can actually purchase a property. Wait, first, God, I'm getting too excited. I'm getting hit. They can purchase a property using this product for more than what they could have initially. So if they could only afford to purchase a $200,000 house, now they might be able to afford a $300,000 or $400,000 or $500,000 house, depending on how much equity they have, and still not have a mortgage. Like I was like, what? It's a wonderful thing.
It's a beautiful thing.
Tell me more
An
about that.
example, a perfect example of that is going to be this. A woman in North Carolina loses her husband.
Yeah.
Her children are here in Patterson.
Mm-hmm.
She wants to buy a property here in Patterson, and she owned a house there.
Mm-hmm.
I tried every product, every program I had to get her to qualify for the property she wanted to buy here.
Mm-hmm.
Would not work.
She
Not
didn't
at all.
qualify based on income. Yeah.
Right. Even with her putting down, I'm going to say she put down 60% of it, it still didn't work. She was
Right.
77 years old. We were able to take the funds from the sale of the house there, use it to purchase the house here. So a house she could not afford in the forward world was a walk in the park on the reverse side of the table.
Yeah.
Because guess what? We were able to take the money, we were able to give it as a down payment.
Yeah.
She was able to qualify for the reverse mortgage on the other side of the table. And she's happily in the house now. When I email her, say, hey, how you doing? I talk to the kids. It works out wonderfully. So we'll go back to that same scenario we just spoke about.
Yeah.
So your people sell their house
Yes.
and they have $350,000 from the sale of their house.
Okay.
In the real world, they want to pay cash for that house. So that same $350,000 that they would normally go and put as a complete down payment and have no mortgage payment, but also have no $350,000 anymore.
Right.
So our 62-year-old person could buy that same $350,000 house
Yeah.
and put down $247,000
Mm-hmm.
and keep the other $100,000 in her pocket
Right.
and have no mortgage payment.
Right.
So all of a sudden, what you did for her is this: you gave her the ability to buy a house, not have to worry about the mortgage payment. So the same thing that she was trying to do, she still would have to pay her taxes and insurance. She's still going to have to pay that,
Yeah.
but she's not going to have a mortgage payment. She'll be able to take the $100,000 that she kept and do whatever it is she chooses to do with that funds. Again, now the financial advisor comes into play, and you give it to him, and he calls up the realtor and say, maybe we could do it this way
Right.
and make it grow.
Right. And in addition to that, so on that $350,000 house, she still has no mortgage payment. Like the cash out was just the cash out. That's money she saved up front. She still
Correct.
has those other 5 options or other 4 options available to her for the balance of, you know, whatever equity she has in that new property.
So
So
that's a
that's one
beautiful
way.
thing.
Yeah, and she could also buy up. So now she can afford more than a $350,000 house.
So
That's the
that
exciting
same
part.
person puts down to $350,000. She now qualifies for a $550,000 house, and
Yes,
again with no mortgage.
with no
So
mortgage,
when
just
you're
tax and
looking at
insurance. Yes.
that's so with this, what it does for you, what the reverse mortgage does for the person that's 62 and over, is it opens up a lot of doors for you. It gives you a lot of financial freedom that you didn't have before. And it also puts you back in control of what you actually do. And the beauty of it is you never lose that control. That control is always yours. So you still own your house. Nobody can take it away from you.
Yes.
It still grows in equity if there's the potential for it. It's still there. So all the things that you normally would do, it's right there for you. So I think it's one of the best programs
Awesome.
out there
Mhm.
for our seniors.
Yeah.
All we have to do is make sure they understand that it's just a mortgage. There's
Yeah.
nothing, there's nothing sinister or anything behind it. It's just a mortgage. That's all it is.
Yes. This has been really, 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 really wonderful. And I just want to recap. So 1988, Congress passed this law for our 62 and up population. And it's a mechanism so that they can use their housing wealth. So for folks who have equity in their property, they can increase their cash flow. They can decrease their monthly expenses because now their monthly payment goes away. They can add money back into their retirement savings. And thing that most excites me is that they can purchase another property of the same or greater value as a 62 plus person. So all this, they have no monthly payments. They don't give up their home ownership, which is a myth. They're still entitled to the property. It doesn't belong to the bank. It still belongs to them. They don't have to repay more than the house is worth. So the heirs still have an opportunity, if they desire, once their loved one passes, they can buy that house, or once they move, they can transfer that equity somewhere else. They can use that equity to purchase another house of greater value if they desire to do that. They can get the money as a lump sum. They can get the money as monthly payments for a period of time. They can get the money as a home equity, an equity line, just taking whatever they need whenever they need it. Or any combination of above. And they don't have to pay any monthly payments. All that's due on the loan are the taxes and insurance. And they can pay that not at all. If they plan to stay in the property, that those taxes and insurance will be just added to the back end when they transition. Or if they want to make that payment every year or whatever, they can still do that, right?
Correct. And what has happened with one of my clients is that they did the reverse, and the children are paying the interest payments for them.
Oh, awesome.
Because at the end of the day, it's their, she said, this is their inheritance. Yeah. If they want to make sure that it's here, then they can pay it so that they'll know exactly what the value is. And it's a good thing. It actually works along, it works out really well. There's a whole lot of combinations and a whole lot of ways that this mortgage is a beautiful thing.
It's a win-win. Mm-hmm. It's definitely a win-win-win. And they passed a law too recently where they can also, the senior can also, or the lender can roll in, I think, at least 10 years worth of taxes and insurance into the loan, so that those taxes and insurance are being, making sure that the taxes are paid, I believe, for at least a 10-year period, just to make sure that it's done. So, yeah.
Now
I can't hear you.
And sometimes sometimes we have seniors with credit challenges.
Yeah.
And you might have to include those things in. And if we do it, it works out well. They want this program to work because there's nothing better than being a homeowner. And it's one thing to have worked all your life and to have had your house. And now, as you get older, you can't afford to stay in your house. Why not take this program and use it so that you have no issues, that you're able to stay where you've been?
Indeed, indeed. Well, I just want to thank you for coming today, for sharing this information with everyone. If you could just share your contact information so people want to get in contact with you as a resource for this product or any other loan product, how would they reach you?
Okay, it's Antrone Daily, and my website is myonlylender.com. It's just that easy. You can go to My Only Lender. You can give me emails. You can do scenarios, whatever it is you need. You can get me there. My phone number is 201-486-3200. 201-486-3200.
Awesome. Thank you again, Antrone. Please reach out to Mr. Daily as a resource. I want to thank those of you who are watching live, or if you're watching the replay. If you found this information useful, please like the video and share it with others. It's very valuable information. And once people have the information, they can make better choices and better decisions. I want to thank you again for tuning into Lyonsview Realty Financial Fridays. If you're looking to sell, buy, invest, rent, or if you're looking to pursue a career in real estate, you can drop a message to me on Facebook, or you can email me at info@lyonsviewrealty.com. Call 856-209-0905. The Lyonsview team, we're here to provide you with resources, information, and tips to help you make the best financial decisions to build wealth now and in the future. I'm sending love, light, and prayers to all of our essential service workers, to those who are impacted, our health professionals, police, fire protectors, food providers, definitely our leadership, and everyone who is working, practicing physical distancing, while we maintain our positive social relationships as we move through this season. My name is Clara Lyons-DeVaughn. You can join us live every Friday at 9:30 a.m. Until then, keep living your best life. Thanks, Antrone.
Thank you.